Hello. All right. For those online, oh, someone's got a mute. We're getting there. Yeah, so this will be your mic.
Yeah.
Okay. I don't know. So thanks for joining us in person and online. Appreciate you waiting a few extra minutes while we got a few tech things sorted. But yes, welcome. For those I haven't met yet, my name's Angie. This is Justine. We're both with New Ventures BC. Thank you for joining us. For those who have attended the last couple of weeks of seminars, we did one on pitching, then we did one on raising capital, and this is kind of the legal, structural required follow-up to all that discussion. So it's placed well on the schedule. So we've got Geoff, Samuel, and Hardeep, right? Hardeep here from Fasken. They're going to talk through corporate structure for startups. But first, I'll just go through some housekeeping and then I'll pass it over to them. So first, just in terms of basic housekeeping, there are some drinks and coffee here. And then the restrooms are just out this door. That's a little hall and a door to the left for those in person. For those online, feel free to ask questions in the chat and we will ask them at various intervals. So feel free to ask one. Otherwise, I would of course like to respectfully and gratefully acknowledge that we are on the ancestral and unceded territories of the Musqueam and Squamish and the Tsleil-Waututh nations. I would also like to thank sponsors for our competition. New Ventures is a nonprofit, so we get to do this fun stuff because of great supporters. So that includes Innovate BC. If you've been to our events, I think you've heard me say about 200 times that we are part of the Road to Web Summit, as this event is as well. Our gold sponsors, EY, and of course Fasken, who also host us here often, and we're grateful for that. Silver sponsors, come on in, RBCX, SFUBD School of Business, Talk Shop Media, and FanTech Angels, and lots of bronze media sponsors who are part of our tech ecosystem here. Like I said, Road to Web Summit, all the Road to Web Summit is, for those unaware, are just a series of events put on by all the different ecosystem partners here in Vancouver and BC to help hopefully get you ready for the big tech conference called Web Summit happening at the end of the day. So we are doing a bunch of events and lots of other organizations are doing a bunch of events too. And we'll share those in our on our newsletter, website, etc. Innovation at UBC is one of them. So Chang can tell you about their Road to the Web Summit events. Some partners I'll highlight, Life Sciences BC, they're doing a pitch event as well. If you want to do more on pitching, that's I think Wednesday. SFU Venture Labs are doing more around financing, getting to close with a focus, I believe, on venture capitalists. Come on in. And then ourselves, we have more this week. So Wednesday, we have talk on HR and recruitment for startups. And then next week, we're doing kind of our most Web Summit-y event. That's a word. And it's only in person because it's very interactive. It will be with, we'll be focused on media attention, networking, how to comfortably network in a big conference. And we have an improv person. It's a very different event for us, I should say. We have an improv person, we have a media person from Talk Shop, and we have Rochelle Grayson, who leads our marketing accelerator and our Mosaic accelerator. And I can't even tell you exactly what it is. It's going to be a surprise. And that's the point. You know, how to role play, in a sense, a situation of being at a big conference where you might not know what the next question is. So it's good to have your pitch all set up, but then what if someone calls you, hey, I got a question for you, and then you're like, oh, what do I do? So this is kind of a fun, supportive way to practice that. So introverts welcome, and extroverts, and give it a go. We're kind of trying it out this year. That's it for me. So I'm going to now pass the mic to the team at Fasken. They're going to share their screen.
See if I can boot you up.
Yeah. And we're good.
Good.
So we have mics here because the last time we were here for a seminar, I think it was hard to hear at the back. So we have mics this time. But the only trade-off is that if you have a question, we'll repeat the question here so the online audience can hear it. That's it.
I will try to remember to do that.
Please do. Yes. Okay, that's it. Over to you three. Thank
Awesome.
you.
Thank you. Just close this out of the way. Welcome, everybody. Great turnout and lots of folks online, which is great to see. This is obviously, I think, the most exciting topic of all of these workshops that New Ventures does. The title, Corporate Securities and Tax Issues for Startups, it's kind of a like legal 101. Every kind of touches on a broad range of topics for legal issues that you likely want to be aware of as you're starting your business, approaching fundraising, or bringing on other employees or founders or scaling or what have you. So there's a lot of content here. We try to keep most of it relatively high level. Often do these types of workshops on a narrower scope of the topics that we're going to cover today, and each of those could be a couple of hours, and some of it could be a whole kind of law school class, I suppose. But so we cover a lot of stuff at a somewhat high level. You'll probably have questions as we go, and I think the plan is we're going to try and leave as much time towards the end as we can for those questions. So hold on to them. We might get to whatever question that you had as we go through the content as is. Let me see if I can navigate this better. There we go. Most importantly, some stuff about Fasken. No, I'm just kidding. We'll just give you a bit of or introduce ourselves, I suppose. So my name is Geoff Pedlow. I'm a partner in our technology group. So I work with startups, other high growth companies, and investors that fund them, right from ideation through sort of capital raise, and IPO or exit, or just sort of as you become a more established business.
I'm Sam Lee. I'm a partner in our securities group. Tend to do more raising of funds, so public or private money, public companies or private companies, and also do a bunch of private and public M&A.
And I'm Hardeep Gill. I'm a tax lawyer. I often work with startups and with the emerging tech group on like companies at various stages, include from startup all the way to sale. And then I do a lot of transactional tax as well, and to other general tax stuff too. So.
And I think Angie will make slides available afterwards if anyone wants them. You can read about our self-promotional stuff there when you get to it. But just to give you an idea, the platform is national and it's kind of full service, everything you need from when you get started till the full life cycle of the company. What we're going to cover today is largely fits into two buckets. The first being sort of corporate structure, founder agreements, foundational legal matters, and then the legal agreements that you'll come across, particularly in the early days of the business, whether that's with among your founders, with investors, or customers, suppliers, that kind of a thing. Within those two buckets, so corporate structure touches on how to set up the company, and we'll assume it's a company. I'll talk more a bit about that. Your initial cap table, your equity ownership, attracting and retaining team members, employees and consultants and advisors, and then what kind of generally the fundraising process looks like from a legal perspective and some considerations around that. I know there's some other sessions on fundraising, so might overlap a little bit, but we'll try to just focus on the legal aspects of it. And then on the legal agreements front, it's kind of your internal governing documents, your shareholders agreements and founder agreements and stock option plans, and then externally, term sheets and customer agreements and NDAs, licenses, financing documents, that kind of thing. So just to get started, really bare bones, if you're starting a company, and particularly if it's a for-profit business, you're likely incorporating a company. And so that's the option at the bottom, but just to cover kind of in case you hear about these other alternatives or you've looked into them or thought about whether maybe this is for you, these are kind of the other options available to you. So you might have come across a proprietorship, and this is just basically you're operating a business under a trade name possibly, but this is just you individually as an operator. There's no sort of separate legal entity involved. And in many cases, this is how a lot of companies start. You're kind of operating with just a trade name before you've incorporated, and then you incorporate and formalize everything, and then you turn into a company and you're no longer a proprietorship. There's partnerships, which is a very similar thing, but it's two or more people doing it together. Limited partnerships, you might hear about those. Those are usually for like venture capital funds, private equity funds.
No.
You're not you're not setting up your company as a limited partnership. And then you might hear about joint ventures. And so this could be a corporate joint venture or commercial or contractual joint venture. And again, you're usually not structuring your business as a joint venture, but you might enter into one later. So what you're probably going to do is incorporate a company. And you can do that provincially in BC or Ontario or wherever you happen to be. You can incorporate a federal company under what's called the Canada Business Corporations Act, which is a federally governed statute, and then what's called extra provincially register in each province. Or you can incorporate elsewhere. You don't need to incorporate in Canada. A lot of companies that we meet with or talk to ask, hey, should I be incorporating down south in Delaware, for example? And we can talk a little bit about that, but I guess the Coles Notes version of it is if you're located in Canada and operating in Canada and hoping to get access to sort of Canadian beneficial tax rates and tax credits and programs like that, you probably want to be a Canadian company. People often ask because, hey, I've met with this investor and they're in the US and they want us to be a Delaware company, and that's not. Don't let that be the tail wagging the dog, so to speak. You don't need to be a Delaware company just to raise money. A lot of the transactions we do are US investors and elsewhere investing into Canadian businesses. They're very, very familiar with it. So that's a very nuanced consideration, I'd say. And so that's something we could spend a whole session like this talking about. But generally we incorporate provincially. BC is a very friendly jurisdiction for incorporation. It's a little bit more flexible, I find, particularly for venture-backed companies. But realistically, provincially or federally are pretty similar, and you're going to be okay either way. And then this is generally the structure, and I'll hand it over to Sam to kind of give an overview.
I mean, just a really high level. You'll have your shareholders at the top, who are really the owners of the company, and you might have some shareholders holding through a holding company or something like that. And then the box would be the company. So you have the shareholders electing the directors name the officers, and the officers presumably employ the employees. And beyond that, you might have a kind of third-party advisory panel that helps you at a high level. So what is a shareholder? Really, anyone can be a shareholder. It can be an individual, it can be a company, it can be partnerships. And they're generally understood to be the owners of the company. Effectively, they become shareholders by buying shares of the company. It gives them a bundle of rights, and really gives the company money to fund the operations. So, there's no limit on how many shareholders you can have. Generally speaking, the more you have, the more complicated it is to administer the company. So, ideally less is better. But obviously the more shareholders you have, presumably the more money you can raise. We do mention a couple rules of thumb there that we can talk about a little more later. But generally there's some additional obligations if you get over 50 shareholders. And the one thing we do want to note is, when you're bringing in shareholders, that means you're raising money and selling shares, and there are rules on who and how you can bring in money. So that's one of the first times we'll mention that we always suggest that you get some legal advisory help before you start bringing in more shareholders. So what does it mean to be a shareholder? What does it mean to have a share? Really, it's like I said, a bundle of rights that are owned by the shareholder. And these are the rights you typically associate with owning a company. The main benefit is the first one there. No liability aside from your initial investment. So this limited liability means that you could lose the money you invest in the company, but unlike something like a sole proprietorship, they can't come after your personal assets. And that's subject to any sort of other third-party agreements you might have. So, what is included in the bundle rights is really up to you and what you negotiate. We have some examples there, but you could have common shares or preferred shares, voting shares, non-voting shares. You can have rights on how you determine dividends or if they're allowed to have dividends. Participating versus non-participating, which really means, do you get the residual amounts in the company, or are you capped at how much you can benefit? And then anti-dilution down round, that's more later on when you have the more sophisticated investors come in. and want to protect their valuations. So generally speaking, the shareholders, how they run the business is that they get to elect the directors, and the directors are the ones who elect officers and so on. And then the other set of documents that can be related to these bundle of rights are the governing documents. So the articles will generally be your bylaws and will contain all the share rights. And then you could have things like shareholders agreements, subscription agreements, or any other third-party agreement where you can agree to whatever you want.
And so then you have, you know, thinking about that structure we put up on a previous slide, you've got the shareholders that are kind of the owners of the business, but they then elect who are constitute the board of directors. And, you know, the company itself can't physically do things on its own. It's not a person with a brain, and so you need actual people that are tasked with managing or supervising the management of the company. So they're elected by the directors. Generally, there's some circumstances in which the directors can add more directors than themselves, or do other things similarly. You need to have, every company needs to have at least one director, and there's no limit. You could have as many as you want. It gets pretty cumbersome if you have too many. Generally, a common approach is to have an odd number just for voting purposes, but again, you can have an even number. There's nothing wrong with that. It happens all the time. Certain jurisdictions have residency requirements. So in BC, anyone, you know, you don't have to be Canadian resident to be a director, but federally you need at least 25% of your directors to be Canadian residents. Some of the provincial jurisdictions are the same, although they've changed over the years. And then there's other qualifications, like you need to be at least 18. There's certain sort of criminal record restrictions or you know, bankruptcy restrictions, things like that. It's all kind of enumerated in the act, but otherwise anyone can be a director. And the directors are, as I said, tasked with managing or supervising the management of the business of the company. And so you can impose restrictions on this in your governing agreements that you enter into or work with your lawyer to set up. But generally they have kind of the first sort of decision-making authority and to determine the policies for the business. And as a result, there's certain duties imposed by statute and common law on directors, what are called fiduciary duties and duty of care. And this obligates the directors to, in all of their actions, to act in the best interest of the company and its stakeholders. Often these are, you know, you can think of this as, in some cases, or very narrow view of it is to maximize shareholder value, but there's a lot more to that, and it's quite nuanced. But the point is, like, the directors are looking out for the company and not their own personal interest. As a result of these duties, there's potential personal liability, which is important to know when you're putting your hand up and agreeing to be a director. Is there certain circumstances in which, you know, unlike a shareholder who has a limited liability by statute, a director, there's exceptions to that. So breach of fiduciary duty. Some cases, if you're not paying, the company's not paying its taxes, CRA can go after the directors. Not paying your employees, Employment Standards Branch can impose liability on the directors. So things like that, and it's just important to be aware of. And then because the directors are kind of the ultimate sort of policy setting group, they're also usually, generally not, although sometimes you wear multiple hats, you know, actually operating the business. And so there's this separation between the directors and management effectively. And those are the officers or the company to whom the directors delegate that authority and responsibility. So you hire officers that kind of lead that are effectively the management of the business and delegate that authority to manage the business to the officers, depending on what role they take on. You can have any number of officers that you want, and they can have any title that you want. It used to be that you always had a president and secretary. Sometimes you have a chairman. More commonly now you see these sort of C-suite titles, but literally it can be, there's no restriction on this. You can have any sort of title that you like, and we see lots of creative examples of this. And then it's the officers that are kind of effectively running the business and managing the day-to-day. Then there's further delegation to employees that Sam will talk about.
So, and we're gonna make a distinction between employees and consultants, and that's important distinction, but employees, I'm sorry, employer and employees have a, master servant relationship. Essentially, the employer gets to direct how the employer, what type of work they do, the timing, where they show up, that type of thing. Employees are economically dependent on the employer. One main difference between employees and consultants is that employees will have entitlements under employee standards, employment standards legislation in BC or whatever other jurisdiction, things like minimum wage, overtime, vacation, things you'll be used to. Employees can be indefinite or fixed term. And the other difference with contractors is that for employees, you do have statutory obligations, statutory deductions, things like salary deductions, remittances, things like that for taxes. Oh, sorry, and one other difference is under employment legislation as well as common law, you do have notice and severance requirements when you're an employee. So for consultants, they are not employees. They're not entitled to the statutory benefits or other entitlements as an employee. The one thing to keep in mind is just because you call someone a consultant doesn't necessarily mean that, the CRA will agree, for example. They'll often look at, what the relationship looks like and interpret it from there. So just keep that in mind. The real difference is that independent contractors, they are, a business of themselves. They take the risk on taking the project. Usually they'll have some sort of control over how they do things when they do the work, as long as the work gets completed. Independent contractors will typically, be able to work with multiple companies at a time, and they'll typically use their own equipment. So those are kind of the indicia. Typically, they'll submit an invoice to the company. They'll be that will, that might have tax on it. It'll be up to the contractor to register with the CRA, remit their taxes as well as withholdings. And then on, as opposed to having severance or notice requirements, typically a consulting agreement will have specific provisions on how you can terminate the contract, which often can be for, 30 days notice. So for agreements, in the employment setting, oftentimes you work without an agreement. I think that's common, but, we think it would be smart to typically have one regardless. It just can provide some certainty on things like vacation entitlements for severance. And it could limit the liability of the company, in terms of things like severance. There's statutory minimums on severance as well as common law, which is quite a bit larger. So if you contracted, you can find somewhere in the middle. Then we mentioned assignment of IP there. We think it's good to have that in an employment agreement, but it's particularly important to have it in a consulting agreement. If you're working with consultants, there's not an automatic presumption that the IP that they work on is necessarily the companies, the employers. So that's one thing to keep in mind, that typically for consultants, we would say that it's quite important to have that assignment of IP. And then other types of provisions you can have in there. You can have non-competes, non-solicits. In the employment context, it's actually difficult to kind of uphold a non-compete. Courts just don't like, for policy reasons, to say that this person can't work in this industry. But in a consulting agreement, you're more likely to be able to get one through.
Just to highlight a couple of things there, just because this is something I always get questions about. And so to keep in mind, if you have someone working for you, they're either going to be an employee or an independent contractor. You have to pay at least cash minimum wage to any employee. And so a lot of times, early days, you're not paying people anything, and so they can't be an employee. But they may not actually be an independent contractor either. So you're a little bit stuck, and that kind of is just a risk that you take. But however you characterize the people working for you, It's important, obviously, and ideally you'd have a written agreement in each case, but really important to have some document that captures at least confidentiality and IP ownership, whether or not you're addressing their kind of employment or consulting arrangement separately from that. So that's usually how we recommend approaching that in the context of, you know, we're not really sure and we'd rather have no written agreement because we don't really know what the relationship looks like, at least cover those things.
So from a tax perspective, the tax treatment of consultants versus employees is quite different. Like consultants are effectively, if you're a true consultant, they're running their own business, as opposed to employees who are working for the business of another. So that's the master servant relationship that Sam mentioned. So because consultants are running their own business, they're earning business income, and in doing that, they get deductions. So they're able to deduct their expenses and whatnot. And employees are also able to deduct some expenses, but they're very, very limited. And they have to be approved by the employer usually. But then on the other hand, employees have a little bit more certainty of their employment because of the employment standards legislation that applies. And they may get benefits as well of employment. So if there's some uncertainty as to like whether one is a consultant or an employee, generally the courts will look at an agreement as kind of a guide as to determining whether it's one or the other. That is, unless the agreement is just wildly inaccurate, in which case courts are just liable to, you know, disregard the agreement and figure out based on what the facts are, whether someone is an employee or a consultant. And so, you know, to the extent that you do come up with an agreement, it's important that it be accurate to the extent possible. And there are consequences for when somebody is an employee, when they're not supposed to be an employee, depending on where they're practicing and whatnot, or where they're working. So I'll talk about it in a bit. So in terms of compensation incentives for either, particularly employees, there's three main ones. Cash salary, usually, or sometimes there's other sorts of benefits in kind. Not that common with startups, I don't think. Shares and stock options are the others. So an employee might receive some shares, might receive stock options, which is an agreement to purchase shares. And consultants also sometimes are granted shares or stock options in lieu of their services. There's some complications with that because they're not in the employment world. I'll talk about that in a second. So stock options can be issued to founders as well as employees. So founders typically will be shareholders. They're the ones who started the company. So they often will be also working for the company in the early days. And so when they do receive stock options, which is again, these are agreements, rights to purchase or receive shares. There has to be an agreement that governs. So the purpose of the stock options or grant of shares is to bring the incentives for the employee in line with those of the company. Because if the employee is holding these rights or the shares, then you'd expect that they would want the value of those to go up and then that'll only happen if the company becomes more valuable and it does well. And for that reason, for companies that, you know, don't have a whole lot of cash to pay like a large salary, they're pretty important. And the tax authorities like CRA and Department of Finance have over the years, and the government have they know that, and they've incentivized the use of it by advantageous tax treatment. And it's advantageous in the sense that like if an employee receives basically anything from the company, it's taxable as if it was salary. So that's what I meant by like a benefit in kind. So any type of benefit is taxable. It's taxable at the time of receipt. So if somebody if an employee receives the right to get money 3 years down the road, that's taxable today to that employee. So the one exception, two exceptions would be shares and stock options. Like if an employee receives those under an agreement, then there's a tax deferral. With shares, there's a little bit of a caveat, but stock options generally, there's no tax on the grant to an employee. That's not true for consultants. Anyways, so on grant, there's no tax. If there's a stock option given to an employee, no tax. so often there will be a vesting schedule that comes with the grant. And so at the time of vesting of the stock option, which is when the employee has like the right to receive it and it can't be taken back. And so at that time, there's no tax either. Generally, the Income Tax Act doesn't really turn on that. At the time that the employee exercises the option, which is to say, if there's a purchase price, like or a strike price that has to be paid under the option to get the share, when that's paid, generally there's no tax either, provided the company is a Canadian-controlled private corporation. So most startups in Canada will be that. We'll talk more about CCPCs in a bit. But the idea is if it's a startup that's run by founders that are mostly Canadian, then generally it's going to be a CCPC. So these rules will apply in this way. At the time that the share on exercise of the option that the employee holds is at the time it's sold, then there's tax. And the good thing about that is, well, if the share is sold, then there will be money to pay that tax, presumably. There are some conditions in that, like in order to fall under this scheme, the employee would need to hold the share for 2 years. If the employee doesn't hold it for 2 years, then it may be difficult to get, well, there could be some issues getting like capital gains treatment on the entirety of the value at sale. And so in order to do that, there's a 110(1)(d) deduction, which you guys might have heard about, that you need. And so the 2-year hold period will ensure that deduction is there. If the employee doesn't hold it for 2 years, then the non-CCPC rules can apply. So we'll talk a bit about non-CCPC rules for stock options, but just at a very, very high level. So the idea is like this is a company that's either it's not controlled by Canadians or it's not controlled by private entities or people. So that would be a non-CCPC. And in that situation, an option given by that entity could be taxable at the time of exercise. So as opposed to the CCPC world. So in that case, like, you know, on exercise, there would be like withholding requirements for that company. There would be the requirement to pay tax for the employee. If an employee of a CCPC of a startup didn't fall under the rules where they didn't hold the shares for 2 years, then you'd want these non-CCPC rules to apply. But for those, you would want your option to be priced so that the strike value is the same as the value of the like underlying shares at the time of grant. So that's the one big one. And if that doesn't work, then neither of these rules would apply. And then there's the employee won't get full capital gains treatment or the same rates. Anyways, a bunch of details there. I'm not going to like talk about them too much. It's good to kind of understand what the taxation of stock options look like when you're issuing them to employees.
I'll just highlight one thing there too. I know you've got more here, but just to be mindful in the context of, you know, early stage businesses, cash strapped, looking to kind of, you know, increase your runway as much as possible. You likely want to kind of pay your employees and consultants as little as you have to in cash and use your equity as kind of currency as additional compensation. And so you see that all the time, and there's common ways to do it. And the key thing is to do it in a way that doesn't result in either the company or the employee getting the equity has to reach into their pocket and pay a bunch of additional money to CRA. And so I think what Hardeep's saying is, you know, depending on the nature of your business or the nature of the company, there's ways to structure it appropriately to make sure that you're deferring any of that tax until later. And so it's just something you need to be very careful about.
Yeah, like the 2-year hold period, like if that's a concern for a startup, like they're not sure if they're going to be around for 2 years or there might be a sale. Well, then like in that case, maybe it's better to just have an agreement, like a stock option with a very low strike price so that an employee can exercise it right away, or maybe no strike price, so they're just given the share under an agreement. In that case, they're holding the share for the longer period, as long as possible, and then they're more likely to fit within that 2 years. Yeah.
How are the share prices established?
Well, that's a valuation question. I mean, often like there will be different markers, like like if you're financing the company, for example, you may do a valuation. If it's really important, you may do a valuation independently. So
Probably
like,
not. Yeah, I mean, early stage, oh, sorry, and the question was,
Yeah,
you know, how do you value the shares? I get asked that all the time. I mean, the technical answer is I'm not a valuator, I can't tell you.
Yeah.
But you probably also don't want to hire a valuator at an early stage to tell you what your company's worth. So most, there's kind of two most common approaches are, you've maybe raised a bit of money and that's whatever an investor's been willing to pay for your shares is what you think they're worth for your stock option purposes.
And-
Or look at comparable businesses that have raised money and what they valued their business at, and you use that to value your equity accordingly. But it's very subjective in the early days.
Yeah, like I've also seen like in the very, very early days where it's like there's been no sales, but there has been a bunch of expenditures that they just use the expenditures like as the value, because like nobody will really pay more than that for a product that's halfway done.
You haven't differentiated between private companies and public companies. And this is particularly relevant for options, where there's a public market for that election. The private company, how do you sell the shares anyway?
Yeah.
Yeah,
it's
usually
illiquid,
there's
it's
an
illiquid,
exit.
right?
Yeah, so like the CCPC, non-CCPC kind of does differentiate between public and private. Generally, like the CCPCs, it's a Canadian controlled private corporation. So then those rules would apply for private companies where there generally won't be a market. And so if there is a sale, it's going to be to like a shareholder that's coming in on the understanding that, you know, like they'll have done some due diligence to like either buy into the company or to buy the company outright.
But that is one big difference. In a public company, if you're getting options and you're getting shares, you know, the idea is that you could liquidate it, where really in a private company, you're really getting a piece of the exit.
Yeah, so that's why
Whatever that
deferring the
might be.
taxes is important, because you're not, there's no liquidity available for possibly a long period of time.
I have a question about the directors. I know you're this is down the road. When you register your startup, especially in the beginning, you need to provide them this one as the directors. But once you are just at the beginning of the journey, it seems like are those the people you have as your directors, are they also considered as the board of directors, or do you make the differentiation down the line? Because in the beginning, you can just find anyone so they can register that. They may not have the qualification yet. So how and when do you make the distinction between the directors for your own and then their own ones who have the structure in place?
Yeah, I don't know if this answers your question, but usually you're, you know, if you're a solo founder or you have two co-founders, there's three of you, often you're incorporating the business and either you're the sole director, you're the sole shareholder, sole director, sole officer, sole employee. That's very normal. Your board of directors is just your group of directors. It's the same thing. It's not a different concept, if that answers your question.
Yeah, it's good that because you still need to have at least one who is not you, if you are so.
No, it can be you. Yeah. That's what I mean, is it can be the same person for all of them.
You can have one director.
We're gonna, just to prevent getting too far off the rails, we're gonna try to do as much time as we can at the end for questions for folks, and also open it up online, and I just don't wanna make sure we don't miss too much of the content, which has happened before.
Oh, yeah.
So,
There's a lot of content.
we'll forge ahead, but don't forget your questions and we'll come back to it.
So just like very briefly on stock options for consultants, because it's often the case that, you know, you have consultants and you have employees that are working in side by side in the early days. And so they may receive the same sort of compensation. Consultants aren't taxed the same way that employees are. So there's no deferral when they receive an option. So for consultants, like that's business income. So they're receiving something for their services, like an option, even if it's an option with a strike price or an exercise price that's the same as the value of the share. That option still has value because in the future it may, like the share price may go up and exceed the exercise price, and then so that opportunity is worth something. And so it's advisable for that consultant to figure that out and assign a value to the option, include it in their income. If they've done that, then it's possible that on exercise of the option, there won't be a tax event. If they haven't done it, then it's likely that it would be taxable like income at that point to the consultant. And then they would hold the option, and then at sale, it would be either taxable at a capital gains rate or at income rates. And capital gains and income, I'm like talking about that, like capital gains generally are tax only 50% of what the income rate would be. And so it's preferable if you can get capital gains treatment. Depending on like how a consultant holds the options, it's possible to do that, but it isn't always possible. The last part, talk about on the employee side, is just the cross-border employees. It's often the case with startups, like especially in the tech world, like information technology and whatnot, that an employee doesn't have to be in the same jurisdiction as the company. And so if a Canadian company goes out and hires somebody to work outside of Canada, then it's possible for the Canadian company to have tax obligations in that other country or jurisdiction. And so that's something to just think about if you've gone out and if you want to employ somebody who's not in Canada. And so the sort of like issues that I'm talking about, like, well, that the company could actually become taxable in that other jurisdiction by having like that employee there. And so you want to plan for that and think about it. Consider the double, like the income tax treaty that might apply if there is one. And it's more problematic the more senior the employee relative to the business. So particularly if you have somebody who's holding office, that can be a big issue. Just think about it very carefully before doing it. So there's structuring to address all of that. It just needs to be thought about before it happens. If you have non-Canadian employees or non-Canadian workers that come into Canada to do work for the company, sometimes that happens, then there might be withholding requirements. There's like what's called Reg 105 withholding for non-employees, consultants that enter Canada and are doing work in Canada for an employer or for a business. And then if it's an employee that's non-Canadian employee that comes into Canada to do work, then there's additional withholding requirements that might be there in Canada that wouldn't otherwise be. And then there might also be withholding requirements in the country that they're coming from. And so it could lead to, even if you think about it beforehand, there could still be no, like double withholding would require, or would lead to like almost no salary left for that employee. So you have to think about it. This sort of issue is not as common if it's interprovincial. So if you have an employee in another province, that's generally okay. There might be a bit of a withholding mismatch in that when an employer does the tax withholding, it may be too much or too little relative to what that employee will have to pay in taxes at the end of the day. And so there might be a bit of a surprise for that employee. But like BC tax rates being what they are these days, I don't think like there's no other province where it's like too different except for Quebec. Quebec you have to watch out for because there's additional employment standards type of taxes that might be payable.
One quick thing about sort of non-Canadian employees or stock options in that context is the US in particular has very complex rules and tax rules around stock option grants. This may seem complicated. This is very simple relative to the way that it works in the US. And so just be extra careful if you're promising equity to particularly employees in the US, but could potentially apply to consultants or advisors or others. So directors as well. So yeah, it's we're Canadian lawyers, and so there's only so much we can say about that, but super complicated, not very fun.
Yeah, you definitely don't want to have to you don't want a situation where you've done it and they have to figure it out after fact.
Yeah.
Because very often it's just not going to work from like the US standpoint. So, and then vice versa, sometimes it happens as well, but yeah.
Oh, advisory board. So this is kind of, again, it's not a formal structure. There's no legal kind of category of an advisory board but it's a common mechanic used particularly in the startup context and where businesses are at an early stage looking to get advice from industry experts and others or finders or that kind of a thing and don't really want to don't really have the means to pay them in cash separately. So advisors are generally just consultants that you've engaged to provide kind of ad hoc advice to your board or your management. and typically comprise what you might refer to as your advisory board. And this is in here primarily to make clear that like it's not a formal structure. It can be pretty informal and ad hoc, but there's kind of industry standard approaches to it. And so your advisors, you'd want to, just like you for any consultant, you'd want to have a written agreement with them. And usually they're compensated with stock options. Sometimes the vesting schedule is a little bit different than you have for your employees. We can talk about we'll talk about vesting later. We've got a section on stock option plans, but this is a very kind of normal thing to add on to your kind of group of people involved in the business.
And we just wanted to raise this, as Geoff mentioned previously, your directors and officers will have fiduciary duties, where they, have to act in the best interest of the company, not in their own interests. So, this will create conflicts within your structure. Typically early stage, your directors will be your shareholders, so they'll be thinking of, themselves with two hats. Within the company, you could have a director who's a director of another company doing work together, or the company and an educational institution. I mean, just generally speaking, keep in mind there's going to be a bunch of conflicts. So think about that when you're bringing people and when you're wanting to serve on other boards or in other capacities. As a director, your role is to act in the best interest of the company. An example would be, if a lot of when you get higher up, that your investor will ask for a seat on your board, and you can do that. If they're sitting on your board, notwithstanding they're a shareholder and they have their own interest, their decisions have to be made for the best interest of the company, not their personal interests. And that can get messy.
Yeah. Keep track of kind of which hat you're wearing when you're doing it. Like you obviously as a founder, you're probably the shareholder or maybe the largest shareholder of your business. But decisions you make as a director aren't necessarily, you shouldn't be focused on just ensuring that your shareholdings as a founder are prioritized. That's not your role as a director. So it's just managing which hat you're wearing, and you get more familiar with it as you go. Now that you understand kind of the parties involved, we'll go through kind of what the initial structure might look like. And so you're setting up your company, and the sort of initial capitalization of the company involves issuing founder shares. And maybe this is you as a solo founder, or you and a group of other founders decide on what kind of the allocation of the ownership of the business that you'd like to have. Typically how this is done is you structure the company. Again, it can be as complicated as you want, but generally we recommend keeping it very simple. You'd have one class of common shares that all of your founding shareholders would receive in their agreed proportion, issued at a nominal value. The company, you're just incorporating it. There's nothing in it yet. There's no value there. So you pay kind of a fraction of a penny each, and maybe collectively put in $100 to get your maybe 10 million shares. Usually recommend using a kind of large number, because later when your company's worth, $10+ million, you're talking about $1 per share, not $10,000 per share, which gets quite cumbersome. And the idea here is that it's you get all the equity early and you're kind of earning into it. And that's what the kind of sweat equity reference here is. It's I think I actually talked about vesting ahead, but if not, you want to vest. Typically when there's multiple founders, you'd usually vest into the equity over like a 4-year period. And you'd have that arrangement in place at the outset in case one of the founders leaves and you need to replace them, or you just kind of have it reflect that, yes, you were getting 25% of the business, but that was on the basis of you sticking around for at least 4 or 5 years or whatever arrangement that you make. As I mentioned, just sure, we'll do. Actually, I saw you put your hand up first, so we'll grab that first.
Sorry, I don't know if it matters. Just that if you can touch later on when you're doing the FAQs, that is this a best practice or it is a norm? I mean, is it mandatory to have in this range the nominal price value, or it can be any of that?
Yeah, typically when you're initially capitalizing the company, like at least among the founders, you will just allocate the equity and not ascribe really any value to it. Having said that, while you're doing that, you're probably putting money into the business at the same time. Usually you're just funding operations using your personal credit card or paying, bills here and there. often that just gets recorded as a shareholder loan. You could instead each agree to put in $10,000 each or $100,000 each and do it that way. That's, certainly nothing wrong with that. I would just say this is the most common because usually, who's paying the expenses is not necessarily proportionate to ownership. And so think about ownership and, funding expenses as you go kind of as separate things, but
That makes sense, thank you.
Yeah.
But it does make sense more if you wanna, sell the shares that go with the loan on a nominal value, which makes sense.
right, exactly. Yeah, yeah, and you can do all kinds of fun tax planning at the foundational stage too. And I'd say sometimes with serial entrepreneurs with deeper pockets, you might do a lot more of that. Maybe you've got a family trust and all kinds of other stuff. I would say for most companies, most founders just getting started, the simple version of this is what the kind of is the cost effective version too. So this is just our most common approach and it works for most businesses. Go ahead, yeah.
From my experience, I've found that fractional shares, if they're too small, it puts off many shareholders because they're looking at you're getting the stock practically for nothing, and they want to see you put more equity into your company. So we need to price it accordingly. So optically, you're not looking like you're on a free ride.
Yeah, I'd say well, I understand that rationale. I'd say most of the time though, like founders are, you're contributing your work and the intellectual property you've developed and kind of the
I
brand.
understand that, but investors still look at that. If you have 0.01 fractional percent, and they're paying say 25,
Mhm.
they still may have some issue.
Yeah, and then the response is usually as the founder, I'm putting in all the work and not drawing a salary and I'm asking you to put in some money and I'm doing all the work. Like that's kind of the corollary. Yeah. Issuing founder shares, again, it's usually just the founder group. You're not issuing founder shares to just anyone that ever gets involved, including like advisors to the business. That's what stock options are for. And we'll talk about that a bit later. You're also not just giving away founder shares to usually investors that are coming in, like they're buying shares at an agreed price or on a kind of non-priced instrument, which we'll also talk about a bit more later. Some issues, I covered a bit of this, but again, you don't want to issue too few shares at the outset. Don't just issue 100 shares to yourself or like, 25 shares to each of the four of you. And then suddenly your shares are worth $10,000 a share. It just becomes cumbersome and then you need to split them later. Start with a high number. Maybe it's an aspirational to start with, but it's very common to have shares issued at, 5 cents a share, 10 cents a share until you grow and you become much larger. And then think about too, like you work on your allocation among your founder group, but keep in mind that's going to get diluted over time, whether that's, equity incentives for early employees, or getting diluted by, other investment coming in. And then vesting is really important when there's more than one founder involved, particularly setting that up right at the outset to ensure that, incentives are aligned. People getting started in a business aren't always as committed to it 6 months or a year later or 2 years later. And so having a agreement in place from day one that deals with what if one of you leaves, I think is very important. So it gets ahead of founder disputes, which do happen. And this solves a lot of the problems that otherwise arise. And then just don't just give your equity to everyone you come across. It's like be careful about it.
So one of the important things about when you're starting up and structuring is that Canadian controlled private corporation status that we talked about earlier with stock options. Like under the Income Tax Act, that concept is like it runs throughout. It's quite important throughout. It determines like the way that the company is going to get taxed. And it's possible, depending on the way that you structured it and who's holding shares, that status may not be available for a particular startup. So for example, like if there's somebody in the US or somewhere else who's investing like a large portion of money into the company and they want the rights to purchase like, more than 50% of the shares down the road, that might by itself put the company offside of the CCPC rules. So the company is no longer a CCPC. And then that would mean that the advantageous stock option scheme that would otherwise be available is no longer available. And the company, if it was going to get, shred incentives, so like scientific research and development expenditures, like a refundable, on filing taxes. Well, like it may not be refundable anymore. So like all of a sudden the company has to make an income in order to actually get back its shred. And so like that happened because like the one decision to issue like a right to another like non-Canadian shareholder to purchase shares and whatnot, that like, maybe that decision wouldn't have been made if this was in mind, like if they were aware of the consequences of doing that. And so there's a lot of advantages that go with being a CCPC. So there's a small business tax rate. So income up to 500,000 of the company will be taxed at the low rate of 12% as opposed to the general rate of 27%. So that's a 15% difference, which is pretty important when there isn't a whole lot of income to begin with to go around. That you'd be able to be like take what you do earn and actually use it in the company. Yeah.
Just a quick question, what is the percentage?
Yeah, we're going to talk about that in the next slide. Yeah. So the like other big incentive to keep CCPC status is it's a requirement in order to access the lifetime capital gains exemption. So if you're a founder that's holding shares of this company, if it's a CCPC and you've held the shares for 2 years and the company meets a bunch of income tests I'm not going to get into, and then it's sold, then up to 1.25 million of the like of gain on those shares is exempt from tax. And so that's really important for most founders, I would say. So that's like a lifetime limit. So you can only use 1.25 million over your lifetime. I think it's subject to inflation, so it'll increase over time, the limit. So some more might be available, but that's like a big incentive to keep the CCPC status. And the other one was the shred benefits. So there's a 35% tax credit for qualifying expenditures as opposed to 15 for non-CCPCs. And it's refundable up to $3 million of expenditures, which means you don't need to earn an income in order to file your taxes and get your shred claims returned. So now just how do you meet CCPC status? Well, it has to be Canadian, like a Canadian resident company. So Canadian incorporated and resident in Canada. Public corporations and non-residents cannot together own more than 50% of the shares of the company. And so if there's a whole bunch of different non-residents and a whole bunch of public corporations or companies that are owned by public corporations, then if all of their shares together are more than 50%, that could put you offside. There's like structuring that you can do to like offset that. So like if you talk to like a tax lawyer or accountant, generally they might be able to suggest something depending on the circumstances. If that's absolutely necessary, I would advise, especially at the early stage, that you try to avoid that. Yeah.
How do you define non-residents, right?
Non-tax resident. So this would be somebody who like it's not based on citizenship. It's based on where they are required to pay like their worldwide income tax. So like if you're living in the US, and you're investing in a Canadian company and you basically are tied like domiciled in the US, you'll be taxable there, whether or not your income's earned in the US or not. So that's not a Canadian tax resident. Yeah. And then public corporations are what we would think of as public corporations, like listed and whatnot, or they've filed an election. So the other thing is that if your company, your startup is controlled by any one non-resident or any one public company, public entity, so controlled in the sense of like directly or indirectly. So like there's just one very powerful shareholder. They may have like say 15% of the shares, but the rights that they have in respect of like what that company can do are so strong that they're able to determine what the company is able to do. Then that might constitute factual control of the company, and then in that case, the CCPC status can go away as well.
This is sort of valid for both the resident or non-resident, or only for non-resident control clause.
So,
if a founder could have majority shareholding.
well, if it's a resident founder that controls a company in that way, that's okay, because then that's what you want, like a Canadian resident to be in control of the company. The problem is if you have a non-resident that like one non-resident or more maybe that control the company in that way, that's a problem, or a public
Doesn't
company.
necessarily need to be 50%.
Yeah.
It could be less if factually they control.
Yeah,
the
like, so you're trying to design a situation in which like this non-resident has a preferred like entitlement to the company somehow. So you're trying to get around this like 50% of shares rule by like giving them other strong rights, then that could still put you upside.
So you set up the business. We'll talk quickly about some sources of funding, sources of capital, and kind of what a financing transaction might look like from a legal perspective. As you may already know, or hopefully know, there's kind of, you either get non-dilutive funding through grants, R&D credits, government programs. You can borrow funds, whether that's privately or from a commercial bank, unsecured or secured debt. That's all non-dilutive in the sense that it doesn't include equity. Or there's dilutive funding, which is you're issuing additional equity in the business to somebody for funds coming into the company to help it grow. And so dilutive funding is kind of more what we're talking about here. And so that's, either equity, it's a fixed, shares at an agreed price, or potentially sort of non-priced instruments like convertible notes and safes, where you defer that valuation discussion till later. Where does the money come from? Number of different sources for dilutive equity investment, but kind of general categories are highlighted here and on the next slide. You could invest money yourself as founders. That was one of the questions we had earlier. Why are the founders not paying anything for their shares? Well, they can. If you have money, you can put in money to the business. Friends and family love money, so to speak, is just kind of people that are willing to invest in you and not really as interested in kind of the technical financials of the business. It's more of a sort of trust investment. Very little kind of diligence done on the business. It's really just investment based on the relationship. Angel investors, these are successful entrepreneurs or other sort of high net worth individuals that invest in kind of early on in the stage of the business, high risk, still kind of limited diligence on the business, a lot on the investment in the kind of founder or management team. And often these people kind of have a bit of an industry focus or maybe industry expertise, and may or may not have a valuation ascribed to the business at this stage that you're bringing on angel investment. Then you have sort of institutional investors, seed and venture capital funds, private equity. These are sort of professional investors that are investing other people's money. They're their own limited partners. And then typically these are more heavily negotiated transactions. They're purchasing kind of senior equity in the business. They'll require a whole bunch of rights to sort of help, their downside protection, ensure they have some sort of veto control over certain actions the company might take, and otherwise, mechanism to protect their investment in the business, and usually much more heavy diligence. A lot less of a just handshake and trust type investment, more of a, we want to be certain that this is kind of the right place to put our money. Strategic investors, I would say, generally fall into that same category, but maybe investing for different reasons. They're trying to get, maybe a toehold into your business, possibly as a potential acquisition down the road, or to just diversify their own business. And so they invest in a similar manner as you would see kind of institutional funds, but usually for different reasons. And so the negotiation of that often looks different, may have a commercial arrangement tied to it, for example, or they want to have the ability to kind of preempt any acquisition you might encounter, that kind of a thing. So these last two slides could be an hour on its own. I've covered just like very kind of basic understanding of it, but that's kind of the equity fundraising environment. And I'll talk a bit about kind of structures too, but I'll let Hardeep jump in with.
Yeah, just a little bit on like financing. So like there's a number of different ways of financing, like so that the company has money. So you can get like debt, you can get loans from people or other entities, or you can get them to buy shares, so equity. So like if it's a equity financing, then like there might be a decision as to like, well, how do you give your equity of the startup to this financier? Like I think the founders may often, in some cases, want to sell their own shares, because then they would be able to get the money themselves and choose whether to put it in the company or not. But if somebody's coming in, they're not going to want to like buy shares from an individual. On a sale of shares, the individual would get the capital gains treatment, so that's like beneficial to them, but it doesn't really help the company very much. So the financier probably will want to buy new shares from the company itself directly, so put the money into it. They may want some sort of preference just to secure their investment, so that if the company isn't doing very well, then they'll be the first able to get out of it, like by by relying on the preferred shares that they do get. And then there's other considerations like for paid up capital and whatnot. So you can do a return of capital up to the paid up capital without tax consequences. So for that, they may prefer to invest in a new class of shares as well. If it's debt, then there's considerations involved. If you have like a non-resident again, that's investing in your company. And so if that non-resident is related, you can have all sorts of rules like that prevent some deductibility of expenses within the company. If there's too much debt that's being used, and it can get pretty complicated. So it's good to know like who the investor is and what the tax consequences are there. If they're asking for convertible notes, there could be issues there too. You want to make sure that the note is convertible, but there isn't any other consideration that's paid for technical tax reasons at the time of conversion. And so there's like a lot to consider just there, and it's like there's much more depending on what you're doing. So it's just something to be aware of before you sign that deal.
And then this will just give you an idea, based on the stage of your business and the amount of money you're raising, kind of an idea of what that process might look like, who might be involved in funding it. And the general theme here is earlier stage business, often, simpler from a diligence perspective, simpler from a, dollars invested perspective. And so, as the dollars invested increases and the value of the company increases, more time and energy is spent negotiating kind of the deal protections for the investor or restrictions on the company and that kind of a thing as you get into later stage rounds. So that's kind of, and also the discussion of valuation changes in terms of whether you discuss it at all versus whether it's kind of a fixed pre-money amount. I've got a couple of slides here about kind of the early stage structuring. You may have heard about safes or convertible notes. These are instruments used, kind of legal instruments used to raise money on what's called like a non-priced round. And so often early stages that the market has kind of accepted that it's difficult to put a valuation on your business. And so we're not going to try to do it right now. And we'll invest on the basis of it converting into shares when you do a round later with a fixed price. And so safes and notes are quite similar in that regard. Defers the valuation. You do often have a valuation cap, so you're not subject to just it going crazy and being 3 years later and suddenly it's $100 million and you were kind of worth $1 million when we first talked to you. So you set a cap on it. And then usually there's a discount rate associated with that to also account for the time that your capital is at risk before that other transaction occurs. But basically, these are kind of equity-like instruments that kind of give you a right to get shares in the future. The main difference between what's called a safe and a convertible note is a convertible note is debt. There's a provision in there somewhere, almost all cases, that if you don't convert, eventually it's going to have to be repaid. Whereas a safe can just sit there for potentially many years and before it actually converts into equity and doesn't create an obligation to repay the investment to the investor. So investors often prefer convertible debt. Safes have become ubiquitous in the market, partly because they're much simpler, a little bit more company friendly, and just sort of recognize the kind of at-risk nature of the investment that, the convertible debt's only worth what the company ends up being worth at maturity. Maybe the company just doesn't turn out and there's no cash to repay anyway. So why did you go through all this effort of having debt in the first place? So it's kind of a high level overview of safes and notes. Sorry, I'll do one question first. I believe it's equity. I don't know. It depends what you mean.
It's kind of like an option almost to like purchase equity more than anything. Like not a stock option, but like it's a right to buy.
And then the other thing on the equity financing, it doesn't really specifically tie into anything what good to be aware of if you weren't already. We've talked a bit about tax credits and government grants. If you're a local business, see if you can register as a eligible business corporation, and your BC resident investors can get a 30% refundable tax credit on their investment. The investment has to be structured to meet the criteria of the program, which isn't that difficult, but sometimes there's I see mistakes made all the time. So make sure you're getting some advice on that, and otherwise this is kind of, I guess, just a promotional shout out for the program. It's great. Most of the clients I work with either are registered or have tried to register and use this program as much as possible, especially early days. Local angel investors will expect that you've at least looked into getting registered as an EBC. So really easy, great way to sort of extend your runway and leverage. We'll take one question and then who had their hand up first, you know? This guy's waving, you go ahead.
What do you need to qualify?
To register as an EBC?
Yeah.
Yeah, you gotta fit into, there's like 5 different programs. And so maybe you're clean tech, maybe you're media, you gotta be in a certain type of business. I would say a lot of startup companies fit into one or more of the categories. Different categories have different budgets each year. Some have more than others, obviously. The best way is to, look on the website, fill out a form, talk to someone at the branch. They're super helpful. And see if you can register. And then you need to have at least 25,000 of equity investment already that isn't tax credit supported. So you as the founder or somebody else has to put 25,000 into the business at sort of at-risk capital, purchase shares for $25,000, and then you can get registered and get your equity authorization. That's the very Coles Notes version. It's a bit more complicated than that. I say they run out every year, not every year. Some years they don't actually. For a few years they were running out every year. But anyway, great program. Securities laws, over to you, Sam.
Yeah, so I mean, I think.
Oh, sorry, but I see Andrea. When do we actually finish? Okay, we'll try to wrap up because I want to leave. I know there's lots of questions. I want to get to.
I'll go quickly through this, but I mean, the main message is basically that, I mean, I think sometimes there's a bit of confusion on who securities laws apply to. So notwithstanding that you're a private company, securities laws will apply to you. It doesn't just apply to, those big public companies that are listed on exchange. The general rule is that companies that issue shares in Canada would be subject to securities laws in Canada. And likely if you're issuing shares outside of Canada, you'd also be subject there. So, at a very high level, the rule under securities laws is that if you're going to sell a share, a security of some sort, you'll either need to file a prospectus or you have to have an exemption from a prospectus. Generally speaking, unless you're a listed company or a public company, you won't be using a prospectus. So obviously you'll be relying on an exemption of some sort. So these are the typical exemptions that you'll rely on, and generally speaking, you'll often be able to find an exemption that works, but I mean that's often. And we'll go into it a little bit more. But with respect to all these exemptions, we just would suggest that if you're ever raising especially external money, you do want legal advice. Relying on these exemptions, typically we would have specific language within the subscription agreements and all that to make sure that you are protected. Technically speaking, if you are issuing capital without an exemption, technically speaking, there can be rescission rights, there can be penalties. So it can, I mean, oftentimes that happens only when, things have gone poorly anyway, but generally speaking, the other part of it, if you're actually doing an exit, they'll probably ask the question, have you considered it? So the first is the friends and family business associates exemption. Generally speaking, you can sell securities to directors, senior officers, family members of directors and senior officers, or close personal friends. There's no limit on how much you can raise from them. But the idea is generally that, you have a sufficient connection to the company or someone within the company that's a decision maker, and you can get information if it's required. Just the one thing that you want to note is that when the securities laws use close personal friend or close business associate, they are trying to narrow it quite a bit. For example, for close personal friend, I think the test we often cite that's not legal is, do you know how many bathrooms are in the person's house? So securities regulators are less, I guess, less popular, and they don't think you can have, 50, 60 friends, close personal friends. It's something more like your very tight-knit circle. So, they're not a close personal friend just because, they're in the same organization, association. They're not a close business associate just because they were previously a client or something like that. Oops. Accredited investor exemption. So this is generally speaking, the idea is that, these people have high net worth, are sophisticated in this type of transaction, and therefore, don't need the expansive disclosure that's in a prospectus. They can they're sophisticated enough to be able to know the risks and to be able to invest. And again, there's no limit on how much can be raised from these type of folks. So, there are a bunch of a bunch of categories that you can rely on this definition, but generally speaking, these are probably the ones you're going to rely on. And you can read them there, but really, corporations with over 5 million in assets, net assets, individuals with over 1 million financial assets, net income of 200 or 300 with a spouse, or 5 million net assets. And keep in mind, all these definitions are very prescribed. Yeah, so for example, in a subscription agreement, we'd want to make sure that the investors are all representing to you that they have these, they can meet these thresholds, and technically speaking, the commissions require you to almost do more and do a little bit of a background check potentially, on if they're meeting these targets. Okay, and the next one is the private issuer exemption. We mentioned very early on, I think that, there was a 50 shareholder limit that could create issues if you go above it. This is kind of where it comes into play. The private issuer exemption doesn't really create more people you can raise money to, but what it does is if you can fall into the private issuer exemption, the regulators recognize that, securities laws are complicated, and if you're smaller, they'll expect kind of less disclosure from you. So, this can be used when the company is tightly held. And do I have the definition there? Okay, yeah. So you can sell it to the same type of folks we talked about: directors, officers, family members, close personal friends, and accredited investors, among others. The one difference is you have to actually be a private issuer. And you'll see that 50 shareholder limit there. You have to have less than 50 shareholders. You can't be, a public company. And there's certain other more technical requirements. But, one tricky thing that might want to pay attention to is that last bullet, is that the private issuer exemption doesn't really allow for you to necessarily issue securities to consultants while still staying as a private issuer. So that's kind of a sneaky way that you could lose private issuer status if you issue, one option to a consultant. Is potential. I mean, you'll have to seek, legal advice and kind of see if you can get around that. But, to be clear, if you lose private issuer status, it's not like you're a public company, and, listed on an exchange. Really what it means is you can no longer rely on this specific exemption. And practically, if you're relying on the friends and family exemption or the accredited investor exemption, then you'll start having to do certain filings and things like that. So again, not necessarily the end of the world, but it does add, some burden, including filing fees and things like that. And then I think this is the last one we'll go through, is the employee, director, officer consulting exemption. Effectively, an issuer can sell shares or securities without the prospectus requirement to employees, directors, senior officers, or consultants, assuming that they're purchasing voluntarily. And so this is the exemption you'll typically rely on to issue options to people. You'll want your option plan to be detailed enough to kind of capture this, but again, any sort of security, any sort of share that you issue, including things that are convertible like options, you'll need an exemption. So keep that in mind. There are things like this that will allow you to issue options, but just keep that in mind that securities laws is always, it's always looking over your shoulder. Yep, and that's it.
And then I think I'm gonna skip ahead a little bit, and then I'm gonna come back. Yeah. So the last topic here is kind of like a grocery list of what are the like legal agreements that you might need to have in place when you're just getting started. These are kind of just what you might hear about or would kind of capture the terms that we've talked about throughout the presentation. And so foundational stage, your founders are subscribing for shares. You might need a reverse vesting agreement like we will. A simple shareholders agreement among the founders, or potentially a more complicated one entered into with your early investors. That IP assignment and confidentiality agreement is very important to have, whether or not you have the employment consulting and advisor agreements. That's kind of your core paperwork at the early stages. And then, what other paperwork do you need from a commercial perspective? You're contracting with customers, possibly, hopefully you are, and generating some revenue, and whatever that looks like. Maybe it's a services agreement. Maybe it's just your website. If you're a SaaS business, it could just be your terms of service or a SaaS subscription agreement. Maybe you're an app. It's your sort of terms of use on your app store page. If you're whether or not you're touching personal information, you likely want to have a privacy policy. If you are, you probably want a customized privacy policy. NDAs are great early days. Like you can hopefully get a good kind of just template to use with potential commercial parties that you're talking to, or others. And that can be one way NDA, or it can be both sides sharing information and agreeing to confidentiality obligations. And then some legal agreements for raising money. NDA is useful too, although many investors kind of don't sign an NDA. Like I realize it's kind of counterintuitive, but a lot of particularly institutional funds, they're looking at 1,000 investments every year, and there's no way that they can agree to NDA with every potential investor that they talk to. But it doesn't hurt to ask. Sorry, I've got something popping up here. Let me just close it. Yeah, I don't know what that is. And then you might have a term, likely, that leads to a term sheet. And then the term sheet leads to your sort of definitive legal agreement, subscription agreement, or maybe it's a convertible note or a safe. For a note or safe, you may not have a term sheet. And I've got a slide here kind of just spelling out, this is what you can expect to see in a term sheet for financing. This could be 30 points, but these are kind of the big ones. What are they buying? What is the price? Or what is the valuation? Or is there no valuation? Is there a valuation cap? What are you using the money for? What kind of rights are they getting? If not just sort of plain vanilla common share rights. And then usually kind of want to lock you up to a period of time to get the actual deal done. So you're not shopping it around to anyone else you can find to try and get a better deal. And then I do want to talk a little bit about stock option plans. So we've talked about stock options kind of throughout this, and maybe you're already quite familiar with them, maybe not, but generally how you deal with, because this is so ubiquitous with startup companies, you often want to have a sort of structured plan in place early on before you start granting options to your employees or advisors and consultants. And you'd want to structure it in a way that kind of governs all of the grants you're going to make throughout the business's life cycle. You'd set aside kind of a certain amount of your equity, which you can change over time. It's flexible. It's kind of just sometimes it's just an arbitrary plug. Sometimes it's negotiated with investors, but it's just set aside so that you can grant options from your option pool as you go. Generally, you want your strike price of your options to be at your whatever your fair market value is. That's often, as I've said, last round of financing, or maybe it's higher now. And then you want to be careful about who you're giving the equity to. Don't just give stock options to everyone you find at any kind of promise that they might help you do something. Be kind of diligent about it, and be restrictive about it. But make sure you have enough there to give it out to the right people. And this is kind of just a very kind of general kind of allocation of what where your pool might go. Senior new hires obviously get more. The more advanced you are, the higher your valuation, the less equity you're going to be giving up. But just be mindful about it being fair, and think about who else needs to get equity later, and make sure there's vesting tied to it. So the standard in the industry is a 4-year vest with a 1-year cliff, meaning there's no vesting until they've worked at the company for a year. Then they get 25%, and then it's either quarterly or monthly for another 3 years after that. And you can negotiate whatever you want, do whatever, however you want. That's just kind of the most common. So that's a little primer on stock options. I know you gotta go. I'll let you go. Other people may be rushing out to vote if you haven't already. And then I'm actually gonna open up to questions here, but I do have, sorry, I'm gonna spend 1 minute talking about this kind of cap table example, because I find it's helpful to sort of visualize what dilution might look like. So, you set up the company, you've got 6 million shares, maybe that's 2 million shares among 3 founders each. You've paid a fraction of a penny each. You've put in total of $600. That's all your issued shares at the outset. Your founders own 100% of the company. You know, raise $200,000 from friends and family at a $1.5 million valuation. So you issue 800,000 shares. Now you've got 6.8 million shares outstanding. Your founder's interest is now 88%, but it's worth $1.5 million because that's the value you've ascribed to it in the financing. So the percentage has gone down, but the value has gone up. You had a stock option plan, 1.2 million shares in your plan. You haven't issued any more shares yet, but on a fully diluted basis, your founder's equity in the bottom right there has gone down now to 75%. And your option plan is 15%. Do an angel round, raise $800,000 at a $4 million valuation. Again, just more dilution, higher price per share, so it's less dilutive per dollar, but more shares are being issued. So now you're down to 62.5%, but it's worth $3 million when it was 1.5 before. Here's a kind of Series A, $3 million Series A at a $15 million valuation. Again, now you're at 50%, but it's worth $9 million. You've increased your stock option pool, which often happens as part of your Series A or any kind of price round. Often that's a part of the negotiation, so that's factored in there as well. So you're fully diluted as 12 million shares. You've still got your 6, but it's now worth 9 of the post-money 18. And then, yeah, you do a Series B, $60 million valuation. Now you're $5 per share. So, you know, again, you're issuing more shares, but the cost per share has gone up. So it's less dilutive per dollar. And maybe you're down to 39% ownership now, which seems like, you know, hey, I want to, you know, where's all my equity go? I barely own any of this company anymore, but it's worth $29 million, which is not too bad. So that's a really kind of quick run through of like how a cap table kind of evolution might go. I realize it's maybe not, probably have some questions about it, but that's the quick version. So hopefully we have time for a bit of questions. Angie, I don't know, do you want to moderate questions? I don't see the online stuff at all, so. Okay, we'll start in person. You had your hand up, go ahead.
Can you get in for the group a little bit about the benefits of crowdfunding exemptions, particularly how useful they are in reaching the amount of shareholders you need for, say, a TSX listing requirement?
Yeah, interesting. Let me caveat this answer by saying the vast majority of the startup companies I work with don't end up going public, and so often aren't planning for that eventuality as part of their fundraising efforts. And in fact, they want fewer investors because that's fewer people you have to deal with that are calling you up saying, hey, what's going on? How's my investment going? So, but if you are going public, most exchanges have like a minimum kind of shareholder requirement. It's often not too difficult to hit that as part of your going public transaction, but something to think about. Yes, equity crowdfunding can certainly get you there if you're taking on, you know, people at $200, $500 a pop, that checks that box. But between doing that round and actually going public, you might have to, you know, that added burden to some extent of dealing with those shareholders.
Like normally as part of a go public, one of the things you're doing as part of that is getting your shareholder distribution. And so, you know, oftentimes you're going public, you're doing a financing alongside of it. Because that's why you want to go public, you want to raise some funds. If you're doing that, you know, you'll probably get agents involved and they'll have a cast a wide net and bring in a bunch of people. Or, you know, if you do some sort of RTO to get public, same thing, you know, you'll rely on the float of the pubco. So, I mean, I haven't really seen too many people rely on the crowdfunding necessarily to get.
Those are very popular in my space and mining.
Oh, okay.
With mining because.
Yeah.
You're having to build a listing.
Yeah.
So TSX 200. So if you bring in crowdfunding, you find board lots, you can easily fill up, say, 100 spaces.
Mhm.
They're gonna, you know, buy, say, $500 to $2,500. That's a very small ownership.
True.
And then they're not gonna be able to affect your stock price in the open market.
Right.
When
Yeah.
you go public. So then you have maybe 100 or 50 larger shareholders, accredited variety,
Mhm.
which you'll be working more closely with to ensure that their valuation on their stock is appreciated. So it's just easier from the management, from the CEO perspective, or a board member perspective, to manage a smaller pool and not have to worry about a board lot of crowdfunders.
Yeah, I'd say certain industries, companies, you know, new ventures in certain industries generally tend towards that go public route a lot sooner, either because it's something that a retail investor understands more than they do software, or because it's capital intensive and that's where kind of the bigger dollars come from, or it's just kind of what's understood. So total mining, great example. Biotech to some extent usually is a bit more of a go public path than you might see for the SaaS business. So I would say otherwise equity crowdfunding is, you know, it can be a great tool. It's really great for consumer products, businesses that are kind of targeting a consumer audience that kind of, you can build a bit of a following by getting them on as investors or otherwise. B2B SaaS doesn't really have that much of as much of a connection, but you could still certainly raise money through equity crowdfunding. Very familiar with it, I guess, to answer your question. See one at the back.
Compensating advisory board is but there's no board advisory board, so we and then when we consider fall off the private investment category, we would have consultants holding shares, so we that create a bridge.
Yeah, and I'm sorry, I caught like 90% of that, so I'm going to try to repeat it, and if I miss something, let me know. But you asked about sort of if you're setting up an advisory board, compensating your advisors with stock options, how do you balance that with your desire to stay as a private issuer? And so generally, like if you can, every time you have an advisor that you want to give equity to, they sign an agreement reflecting that, and usually those agreements kind of either party can walk away at any time, but it's good to have some paperwork. And you'd ask them to certify that they are an accredited investor. So ideally your advisors are accredited, if you can. And if they're not accredited, maybe there's another exemption. And if there's not, you know, maybe there's some argument that they still fit in some other category of private issuer. But usually I like accredited because it's objective thresholds that you know for sure if you're in or out, saves you from having to get advice as to the more subjective thresholds, and it's just easier that way. So hopefully that answers your question. Like if they are accredited, solves the problem. If they're not, there's often some other avenue.
But that was exactly what we were talking about. Just
Yeah.
be careful, because sometimes you can just issue it to an advisory board member and realize that you lost your exemptions.
One more point about advisors, and you can use them by getting an industry specialist, tempting them to come on your board. And that brings validity to your company.
For sure.
Much easier to sell stock when you have a name brand person.
Yeah.
As an advisor.
That's a big one. Early days, because often there isn't a track record or too much kind of, you know, something to show for it. If you've got people involved that bring some credibility.
And that goes back to that original question about directors. You know, normally when you start a company, you are the director, but slowly you'll build that board up depending on what you need. And you know, it might be that you bring in investors who want a board seat, but it might be that, you know, you see someone poking around and is interested in your company and you think he can, or he or she can bring validity to it.
I see one more there, and then I don't know, Angie, if you want to go to online after that. Go ahead. Was there one back there? Yeah.
Period that, let's say advisor is given stock options, is there a minimum period that you hold before
Before, what was that last part?
before converting it
shares?
Usually it's just as soon as it's vested, they can exercise the option and get the shares. I would say most people that get stock options hold on to the option until either it's going to expire or there's an opportunity to then sell the shares. So right before a sale or a go public. But usually the options sort of will expire, or if you're an advisor and you stop advising, you've moved on, your options probably will expire a bit earlier. And so you'd exercise then and get the shares, but technically anytime after they vested, and like you do with your employees or others or your founders yourselves, you'd vest the equity for advisors as well.
And what is it?
For advisors are actually interestingly one of the few exceptions to that standard 4-year. I frequently see like a 2-year, because the only compensation that they're getting is this equity. It is more common to have both a shorter vesting period, and also you could also vest from day one. But having said that, tons of advisors are same 4-year, 1-year cliff arrangement. But yeah.
And would those share options be assigned?
Usually all equity in like your early stage private illiquid company is kind of non-transferable and subject to various restrictions on transfer and rights of first refusal and all that stuff. So usually not, you've got to hold on to it until there's an opportunity to sell.
When you're not a public company, generally speaking, your shares and your equity are illiquid. You can't move them unless you're moving it to someone else who could have bought them through an exemption anyway. So they call it a closed circle. I mean, it would be easy to get around the rules by selling it to someone you can and let them sell it off. But as a private company, you can't sell it outside of those exemptions, basically.
Just on building on that question and this response, can you work around that by through the shareholder agreement?
To allow for transferability, you can. Well, I mean, I guess it depends what you're getting at, but generally speaking,
Yeah, I was just looking.
shares of a private company are illiquid, and you can't sell them to anyone. I mean, generally, one, there's no market, right? Because you're not listed, there's no place to sell it, no market to sell it. But secondly, all those shares are subject to transfer restrictions under securities laws or a shareholders agreement or, your articles. But essentially it restricts transfer unless you can do it within securities laws, and, you'll want to talk to advisors about that.
Yeah.
But generally speaking, you can't unless they're accredited or something.
Basically, if you've got someone that wants to buy your shares, you usually have to go to the company to get their approval to transfer it to this other person that wants to buy. And usually companies, if they've got people that want to buy their shares, the company wants to sell the shares to them, bring the money into the company. So exceptions to that, this happens all the time, obviously, but that's kind of generally how it works. I've got a bunch of questions in the chat. Some of them I think I can run through pretty quickly, actually, so I'll just do that. Can an investment in a business be tax deductible? Hardeep's not here, but like generally no. Like you get the investment tax credit under the EBC if you have it, but I can't think of any circumstance in which like a purchase of shares would be like a deductible business expense. So I think no, generally, but I guess deductible in that sense. Yeah, you could get, and actually you can get an EBC tax credit and put them in your RSP, and you're paying what, I don't know. Yeah, man, like, yeah. And then you get shred credits on the investment too. And yeah, you're getting, your dollars are going very far. It's a great system we have here. Founder agreements with 4-year vesting. What happens if you leave? That's exactly what that's there for. So if you have a 4-year vest and you leave right at your year 2 mark, you're going to keep half your shares and the other half go back to the company, and the company can find someone else to take your place and give them those shares or some other arrangement, but it gets clawed back. Basically, you don't get a windfall, and that's kind of the purpose of that.
Follow up on that. What if the co-founder is actually let go?
Same thing. Yeah. Whether you quit or you get terminated, that usually triggers a clawback of the invested.
That's why you want that in an agreement.
That's why you want it in.
And normally, if you don't have anything, if someone leaves, there was a falling out, someone leaves, there's nothing to mandate selling back those shares. I mean, basically that person has half your company.
Couple of general questions that are going to take a bit longer to answer. Well, let's go to the back first, and then I'll come back and try and do a couple more. That would be a Hardeep question.
Yeah.
I know there's restrictions, like you have to, the business has to meet certain criteria, and I don't know, like, I think you can't own a certain percentage of it, but I don't want to say that definitively, so that maybe what. You've already got the lifetime capital gains exemption, which you want to maximize for sure. And then, you know, maybe you could do some other tax planning too. Maybe you've got a family trust, or there's all kinds of stuff you can do. I don't normally see founders put their shares in their TFSA, so that may be the answer. Yeah, it's zero. Yeah, and then you sell it for, 10 million. Yeah, that'd be great. I agree, but yeah. Yeah. Okay, I'll try to do one more. Does the pre-founders agreement grant the right to participate in strategic decision-making, or should roles and decision-making rules be set out in a separate document? I think this is an important one because I think you need to be mindful of, I talked about allocating equity early, and that's not necessarily the same as allocating, responsibility for expenses early on. Like that may get recorded on your balance sheet as like loans to the company or due from the company. Your ownership interest on a go-forward basis is separate from that. Also separate from that is kind of decision-making authority. You may decide that, maybe it's 4 of you with equal ownership, but one of you is really the decision maker. You're the sole director, or 2 of you are the directors making those decisions. So that's all stuff you can negotiate. You should negotiate rather and put in an agreement and agree on. Otherwise, generally under corporate law, simple majority vote of the shareholders will determine how big the board is and who's on it, and they'll determine day-to-day decision making. So absent an agreement, that's generally how it would work. Hopefully that answers that one. I wish we could stick around for another hour. There's always way more questions than we have time for.
All right, well, we'll wrap there. Thank you, everyone.